So orders are still coming in. Okay, we have another speaker here, Price Headley. Price, can you hear me?
Hello, John. Good afternoon. How are you today?
I am good. How are you?
Oh, fantastic. Thank you.
Where are you broadcasting from today?
I am in central Kentucky, Lexington, Kentucky.
Oh,
So
good. I
it's
bet you have
beautiful.
good bourbon there.
We have lots of bourbon, the whole Bourbon Trail right around the corner here, exactly. So
Exactly.
my mom lives in Bourbon County. So yeah, it's a great spot, beautiful. We've gone pretty much straight from the cold of the winter to the heat of the summer with not a whole lot of spring this year, but unique weather. But it's a beautiful area for sure. Where
Well,
are you,
go ahead and
John?
get your PowerPoint set up.
Sure.
Um, Price Headley is founder of BigTrends.com and was inducted to the Traders Hall of Fame in 2007. A Duke University graduate and chartered financial analyst, he's been trading for over 30 years. Price is a regular on financial television, and his company helps investors profit from significant market trends. Please welcome Price Headley.
Thank you
So,
so much,
Price,
John.
you have until 5 minutes before the hour when we
Perfect.
go ahead and hand out our next batch of prizes. I'm going to go ahead and mute myself, and you have the floor.
Well, you are so kind. Thank you for having me, John. It's always a pleasure to be with you on these Mad Hedge special events. And what I love is hearing, just in a prior talk about leaps, longer term options, and we're talking about the other end of the option spectrum, which is the zero DT, the final day of an option's life, really shorter term trading. And I think the beauty of we do all types of trading here at bigtrends.com, and bottom line is that what I love about options is you can truly customize any time frame, any indicator, any sideways up, down view you have in the markets for any time window. And then it's just about having the proper risk management strategy against what your reward is. So you can set it up for more reward and relatively less risk, right? So that's really what we're doing here. It's the other end of the shorter term end of the spectrum. Of course, many of you probably heard back in mid-April that, the SEC said they're doing away with the pattern day trader rule as well. So it's still going to take the brokers a little bit of time to implement that. But if you're a smaller account trader, you don't have to sweat doing day trades so much anymore looking forward. So it's a really exciting time, I think, for doing zero DT. And we love doing it on the NASDAQ 100 QQQ. When you talk about what's driving the results of this bull market on this latest last several years, it's AI, right? It's artificial intelligence. And of course, the NASDAQ 100 QQQ is heavily weighted towards those big tech leaders, of course, NVIDIA and many more. So we're going to walk through all that. We're looking for up to 500% wins in the same day. I know that sounds incredible and almost too much to believe, but yet it is very doable when you catch these trends that these markets are making. I mean, the markets are moving a lot, as you know, not necessarily always just up either. So we've got a really unique pattern I want to walk you through. Let's get into it. And as we get it started, just to remind you that the information I share with you in today's presentation is based on our proprietary research and is intended for illustrative purposes only. What we're talking about here should not be considered specific advisory recommendations. As you know, stock and options trading have large central rewards, let's face it. They've also got large central risk. And here we're definitely talking about final day of an options life. We definitely need to catch it very quickly. And if it don't, we've got a stop rule and we get out and we move on, wait for the next trade, right? So that's all part of it. It's just following the rules of a system. Remember, the past performance, though, of any trading system or method is not necessarily indicative of its future results. So whatever we do in the past, obviously, we know can vary and will vary in the future, right? The markets are variable, right? We're not just sitting in a bank CD and earning just a few percent. We're looking for a lot more. And for that, we take on risk, right? So it's about managing your risk, though. Smart and intelligent, consistent execution is a big part of the game. So we'll walk you through that. See our bigtrends.com homepage for more information on our terms, how we've done business now on our 27th year here at Big Trends, and I've been trading options since, right? And John mentioned that I graduated from Duke University. Right after I graduated from Duke, got a job as an options analyst and basically immediately got into options now 37 years ago and counting. So walk you through a bunch of success stories when it works. Also walk you through when it doesn't work. How do you manage both sides of the coin? That's a big part of the game here. And then walk you through what we call our zero DTE options trader strategy. So you can take advantage of real-time call outs, when to get in, when to get out. We send real-time emails and real-time texts to subscribers' smartphones when to get in and out, and you know exactly what our rules are on our targets and our stops. We keep reminding you of that so you never miss an exit. More importantly than not just missing an entry, never miss an exit either. So if you know what I mean, I've been trading, like I said, 37 years and counting. Founded bigtrends.com no, November of 99 and blessed to be serving our Big Trends community now in our 27th year. It's always though about no matter how much experience you have to follow your system, your method. You cannot get emotional. You cannot get opinionated. You've got to trade what the system says, not what you believe, what you've been trained to believe from the financial media or whatever you think the fundamentals are in a company. When you're doing short-term trading, it's about the technicals rule the roost, right? The fundamentals, frankly, just kind of take a back seat to what's happening on a moment by moment basis. Let's get into today's event with the recent winning trade example. Then I go into more details on how this zero DTE strategy works. Now, here is a downside opportunity, right? You know, the market, the Nasdaq's been running up like gangbusters. Even the pullback this morning on the Broadcom news, still the market recovering off of those early sell-off lows and coming back up here. Nasdaq back to just down a point after having been down a lot more this morning. But this is a prior example back or about you can say about 3 weeks ago, back on May the 12th. So what are we looking at here? We're looking at 5-minute candles here. This is a candlestick chart, of course. The red bars are the closes below the open on that 5-minute interval. The white open bodies are positive closes with the green shade in there, positive closes above the open. We've got a couple of key trend lines on here. The black line is a kind of a more traditional moving average, but the green line is something a number of shorter term traders are familiar with. But maybe if you've been a longer term investor or longer term even leaps trader, you probably don't worry as much about volume weighted average price, VWAP, it's often called. But volume weighted average price, of course, just what it says, factoring in both price and volume to determine, okay, how much activity is coming in at various levels. And so this is dynamic. It updates, and you can see the VWAP here in the green line that's edging down there on that chart. You can see is breaking down and staying broken down underneath that black moving average. When you become a subscriber, by the way, we give you all of our specific settings for what VWAP we use, what moving average we use. And the other rules we give out to all subscribers, so it's not a black box. You learn it as a paid subscriber. But here we go. So basically looking here at how we're going to manage this trade. Well, we get into an option here where we pay 88 cents, $88 for each contract controlling each 100 shares of the QQQ, right? The Qs, when we got our bear signal here, we're trading just above 705. So that means that if you bought or shorted 100 shares in this case of the Qs, you're talking about 70 grand, 70 and a half thousand dollars that you're controlling in this case for 88 bucks. Now we're using an example in today's slides where let's assume that you come in and say, I'm going to apply this with $1,000 per options trade and never more. So I'm going to be consistent and saying I want to get about $1,000 to work. It won't be exact, but in this case, you see, we get if it was a 10 lot, we bought at 88 bucks a piece. That'd be 880. We're able to get 11 contracts that pushes us in here for right around just over 950 bucks, maybe closer to 970. But the idea here is that 968 we're in, and then we're saying, okay, look, our first goal is how do we get our risk money back? So a lot of times in my original kind of free trade strategies, I would sell half of my position at a double. Well, what we learned, and especially when you're dealing with a volatile instrument like 0 days to expiration, that means that at the 4 o'clock, or in this case, 4:15 is when the QQQ options stop trading. At 4:15, these options will expire, right? They're done trading. They will not trade the next day, right? So we're buying the May 12th options on the morning of May 12th. So our entry window here is going to be pretty much in that first roughly almost half hour. We wait for the first 3 candles to be put in place here. So that's what these other lines that we've drawn, kind of this flat support and resistance lines down on here. We've got an initial support low put in there off of the first 5-minute gap down. And then you see we pop back on the third 5-minute bar. So that's setting in place our first 15 minutes, what we call our opening range, high to low range. A lot of people look at like a first 30 minutes ORB or opening range, kind of a breakout method. We're looking at just the first 15 minutes to give us an even quicker entry window if we get the right configuration of conditions. So for us, what we need to see is once you get that setup having been determined, you can see we're below the moving averages, and we close underneath our opening range window there by about the 6th candle of the day, that's right about 10 to 10:05. You can see that we're basically in that neighborhood where we really need that to happen by about 10:05, or else we just pass. We say if it's chopping around in between that range, it's not breaking out, or in this case, breaking down enough, right? So we need fairly fresh, fairly quick follow through with this opening range setup here. We get the first three candles in, then we're looking at the next three for, are we going to break out up or down with the volume weighted average price VWAP and moving average, kind of confirming that we're on the right side of the general trend. In this case, you can see what happens is when we bought it for 88 bucks, and you see it starts to move down at first, then the next 15 minutes, it actually pops back against us initially. You say, oh, isn't that bad that it goes back into that range? It goes slightly above the VWAP right there. But you see, our indicators say that, hey, it can still do this little bump above the VWAP and still not shake us out as long as it doesn't hit a 50% price stop. So we would rather use the price stop to take us out than a moving average here. Okay, so we don't want to get whipsawed by just a little bit of market noise. You know, this market definitely has its share of noise. That's just kind of a reality of the market that we're in. So you're going to see some whips. So the question is, did you get a takeoff point or a breakdown point in this case strong enough to say that you could have big potential further that trading day, right? Because let's face it, if the bulls are on their heels and the market's breaking down, a lot of those, and let's face it, the institutions are the ones driving the market. A lot of those institutions are just like you and me as individuals. They're saying, I want less, I want to be less long when the market's going against me here. I want to cut my risk down. I want to basically not get hammered so hard, right? If you're an institution, you tend to have to be relatively fully invested, but they'll kind of rotate out of the more aggressive vehicles like the Nasdaq into safer vehicles in other slower moving sectors. So on the other side, when it's going up, they'll pour more gas on the fire, wanting to buy the cues to get more potential to outperform on the way up, right? So in this case, they're bailing on the downside, right? And so in this case, you can see our first, we don't get stopped out. It got maybe down about 35 or 40%. We got close to our stop. That's why one of the caveats is don't get cute and say, oh, I'll put a 20 or 25% stop in and think that will cover me. That will whipsaw you out of a lot of otherwise good trades. And so basically in this case, if you took a 25% stop and you see we end up going to both of our targets, 50 and then 500%, you're really kicking yourself, right? So in this case, look, why do we get out at 50% on the first 8 contracts here? Because if you, instead of selling half at a double, if you sell two-thirds of your position, do this math, sell two-thirds of your position at a 50% gain. Think about it, if you put $1,000 in, it goes up to 1,500 bucks. You've got a 50% profit and you sell two-thirds of that 1,500, you get your original $1,000 back, and then you're in a position where you can free roll, free trade on the remainder of the position, right? But even as we sell about two-thirds, in this case, slightly more than two-thirds, 8 of the 11 works out to like 72% of our position is exited at the 50% gain, right? We're getting a little bit more than our risk capital back, right? A little bit more than about 1,050 bucks back in our pocket after investing about 968. So we're up a little bit, even if the other three contracts went to zero, right? But in this case, the other three contracts is where you really get paid. It's what we would call the runner part of the position. You want to let your winners run, right? So we're on the right side of the downside move here. And you can see that was first exit came there around maybe 10:15, 10:20, something like that. And this is Eastern time, Wall Street time. But notice you say, well, look where we got out of our 500% final target on the last three contracts. We got out right here, as it turned out, near the short-term lows, right about the midpoint of the day. You know, the midpoint of the trading day is 12:45 Eastern, right? Just in that power lunch hour there. You see before 1 o'clock, we're out. As it turns out, the market does reverse. It could have kept going down, right? We're not trying to call a top or a bottom. What we're trying to do is say, give it a chance to run to 500%. What if it doesn't get to 500%? A number of them will not. You let it run until the last about half hour of the trading day. And so we'll show you some of those examples as well. But you can see the last three contracts here sold at over 500 bucks a piece. Means that your total profit on the trade here is 1,672 bucks, of which those last three contracts, you can see, ended up cashing them out for about what, just under 1,600 bucks. And you're saying, okay, well, we only paid rough under 300 bucks, so more than three, right about 1,300 bucks of our 1,672 is made from the final, just about under 30% of our position, right? So the point of this is that that's where you get paid. The idea of this whole trading approach is that you give yourself more staying power when you get your risk money back in your account. And so when your risk money is in your account, give it a chance to keep running. Even if it craps out in the final minority of your position, you can't lose once you've gotten your risk money back, right? So when you start to understand that concept, you start saying, okay, now I can play for the bigger trend, in this case to the downside, right? And oh, by the way, I didn't mention the other thing we want to see is we want to see stronger than expected volume. That's what these bottom green volume bars show you that the volume is above average when we're getting the breakdown, which you can see was happening in line with this, that we're getting that stronger than expected volume surge, meaning that you are getting not accumulation, but the opposite, a distribution, a get me out of this position or get actively short if you're a hedge fund type. So the bottom line is that yes, that's a perfect example of what we're trying to accomplish on our trades. You can see that, okay, we didn't make, we put $1,000 in, we didn't make, you know, $5,000, but we made $1,672 because we took that risk down first, right? You know, the speculator might say, I'm just going to go for the 500 percenters, and then of course you're going to have too many crap outs or stop losses in between that end up basically making you give up, right? So a big part of any trading strategy is you've got to have enough of that risk out of the trade to say, I can stay with this strategy. I can trade that. And so we're going to show you more of those examples. But why should you care? Well, I think it's because this is becoming a very popular way to take advantage of market trends on a day-to-day basis, right? And so from this perspective, you say, okay, look, our strategy here is identify that first 15-minute opening range, high-low range, and then look for the breakout filtered with the volume weighted average price or VWAP combined with the moving average and the volume. We're just going to trade the same day expiration, right? So you know that we're only going to be doing day trades here, and we're not going to do them every day, right? So we would expect that we would get in the neighborhood of maybe a couple trades a week on average, okay? So you don't have to sweat a ton of those, but the idea is that we only want to trade when the setup is in our favor, when the conditions align to truly take advantage of this, okay? So 5-minute time windows allow us to get a quicker kind of a jump start versus those that are waiting for the first half hour. And at the same time, not overreacting to just an opening gap up or down, right? In that case, of course, we gapped down in the last chart and then it did eventually follow through. But there's plenty of times, I mean, today being one example, where you gap down and look, now we've reversed back up to where the Qs are back closer to just slightly down, just getting back at the highs near unchanged here. So the idea of this is that we don't want to chase an opening gap without the follow through confirmation. Okay. So we want to get that first 15 minutes under the belt, get that follow through with the volume, right? And then, so the only window we could get in is between about 9:50 a.m. Eastern and about 10:05 Eastern. So that means you only need to kind of be paying attention from an entry perspective for the first 50 minutes a day. Once you're in, say you're in a buck, you know two things. You know, if I'm in at a buck, say you're putting $1,000 in, you get 10 contracts, you would know, okay, that's 10 contracts at $100 a piece. There's your $1,000 invested, and you know right away your stop off of a buck would be what? It'd be a half a buck, right? Down 50%, I'm gone. You know, your first target is up to a buck and a half on at least two-thirds, which would be 7 of your 10, right? You can't always sell exactly two-thirds, but you've got to sell at least two-thirds up 50% to get your risk money back when you do the numbers. But that's a unique approach. A lot of people know to sell half at a double, but you can start selling more at lower targets and actually dynamically help yourself in your trading to get to risk-free positions much more easily, more quickly, and then let the rest of that trend run. And this applies not just to, we have other services that trade this dynamically for not just day trades, but for swing trades as well on individual stocks. So, but this has really become a very popular way to go. You can see we're just going to focus on that intraday breakout. We're just going to get that confirmation. If we don't get the confirmation, we just pass for the day, right? So we have a number of days where we say, no thanks, not trading. We're not in this for activity. We're in this for really optimizing and maximizing results when the tide and the waves are aligned in our favor together, right? The short term and that rest of that day expectation on the follow through. So the idea here is that you get a lot of leverage. Of course, you're truly getting maximum leverage here with zero DTEs. With that comes higher risk, right? So we're buying typically slightly out of the money options, right? So we're talking about 100% time risk. That's why I always tell new subscribers, start small. Like you could do this strategy starting off with as little as just a few contracts, right? You would typically have to have at least three, and then you're trying to get two of those three out at the 50% gain, keep the last one for the runner, right? So you could do that as well. And still, get comfortable with both how winners work and how stop outs work. It's part of the game. most people know out of the money options, not for widows and orphans, right? This is definitely aggressive growth, but we're using a 50% price stop relative to a much bigger potential target opportunity. Look at our average contract entry price back to 2023 on this system has been under $100 a contract, just 85 bucks or so per contract. So again, that would get you an average of about 11 contracts a trade if you're putting in $1,000 worth, right? But the key is it's not about getting the maximum contracts. It's about keeping your dollar risk contained so you can focus on the right way to trade it and not get too high or too low. So we're using that 50% stop, the 50% first, minus 50% stop, plus 50% first target on the first two-thirds or slightly more of the position, and then the final target 500% with the time stop getting us out on the remainder if we don't get to that ultimate target. You say when you do that, looking backwards since the beginning of 2023, we're looking backwards, reminding you that past performance never guarantees future results, right? The future is going to be different. Could be better than this, could be worse than this. We know it's going to vary, right? But the idea is that you can't allow your emotions to vary. You can't allow your capital to get jumped in too much or jump all the way out too much on any trade setup. You just got to keep on firing slow and steady. The tortoise beats the hare, right? And you want to be slow and steady in your execution too. That'll make you more confident as well as more consistent over a longer period of time. You can see a $5,000 model portfolio grew to 20 over 29,500 gross. That's a $24,619 gross profit. That's gross before commissions, mind you. Of course, commissions manageable, more manageable than ever. And of course, as you start to get more active, you can really get your commissions more and more down. And of course now I see a lot of people are getting it for like a $5 contract with no ticket charges, which is a great thing compared to when I got in the game 37 years ago. I remember even trading a one lot going, man, this is too expensive. You got to have a huge move to get paid. Not so much anymore, right? So you keep the vast majority of what you earn. We're not compounding our results with this. We're showing you if we just keep it capped at a maximum of $1,000 a trade. Right, so we're not trying to take it and say, well, we double the portfolio, so double the amount per trade. We're not doing that. We're saying stay consistent on your dollar allocation per trade. What that will do is while it might not let you grow as fast on the upside, it also won't assure that you're getting too many chips in right before your next drawdown, right? That's what happens to people that compound their portfolios is they grow faster on the way up, but then they give it back too fast on the way down, right? So we don't want to do that. We want to be slow and steady on our capital allocation. That will keep you more emotionally balanced with when you trade the leverage of options in addition to financially more stable as well compared to the compounders out there. So see, that's the gross before commissions and subscription investment, 5,000 to 29 and a half plus. And that's again in the last, you see, on just under 2.5 years, so the last 30 months to up 24 and a half grand gross. So you get the idea of what we're expecting, knowing that we're going to have times that go up faster, times that give back some, right? And that's just the nature of any trend system, any system. And so you see, though, the key setup is define the high-low opening range first 15 minutes between 9:30 and 9:45. Then we're looking at 5-minute candle follow-throughs to tell us, okay, are we getting that breakout with the volume weighted average price in our favor and our unique big trends volume confirmation, getting that volume follow through as well, right? So you're seeing that the institutions are pouring on the gas on the way up or they're saying hit the sell button hard on the way down, right? So we only take those breakouts between 9:50 and 10:05. If it doesn't happen there, then there's no trade for the day, right? A later breakout in the day, no go, not interested. So that's really part of the secret too, is just being disciplined enough to say, yes, let's only follow that. And of course, when you become a subscriber, we got a super subscription special, I'll lock you in for a many months to come and give you where one trade could pay for this many times over. That's our objective always at Big Trends. And I think that's why we keep on growing here 27 years and counting. But, let's go back to some other different market environments because what's been happening here recently with the verticality of the Qs. But what about back in October last year? Right. Well, here's another upside. Here's the upside breakout, right? So you can see before we even start to put on what we did here, you can see right away you've got to define the right off of the open there would make our low for the first 15 minutes. You can see the high is made about that third, even though it's a red candle on that third 5-minute candle there, that high marks our high. So you can see that flat green line marks the high, the red line marks the low of that opening range. You can see right away behind it, we're getting the follow through the next 5-minute close there. So like right about 9:50, we're getting that. So we're getting the email and real-time trade alert sent out there right here. And you can see it does dip in that first 5 minutes after we get that email out, right? So a lot of people would worry like, am I going to be able to get on these fast enough? But the reality is if you can log in when you get the real-time text, which I highly recommend getting in addition to the emails, that's text for me is the fastest way to get notified of anything compared to email. So real-time text to me is vital. And you say, okay, look, I get that text. I've got a trade. I'm logging into whatever options platform you want to use. It's not platform dependent. And then you're just saying, okay, log in. I know I'm putting in X dollars, so therefore I know the price of this thing. We said get into a max. Say we got into a maximum of half a buck. Well, then we say, okay, get 20 contracts in on $1,000. Get a 20 lot working to buy these October 8th 609 calls, half buck or less. Our average entry is 48 bucks. We're 48 cents a piece times 100 per each 100 shares of stock that we're controlling means each contract costs you 48 bucks to control 100 shares of the Qs. So we're controlling 2,000 shares of the Qs here back when it was trading just about 607, right? You think about that and you're like, well, each 100 shares would cost you over 60 grand. So a 10 lot would control 600 grand. A 20 lot's controlling $1.2 million worth of the Qs for 960 bucks. Okay. You like that leverage potential? Yeah, I do too. So the idea here is that, okay, we bought 20. We want to sell two-thirds when we get up 50%. So from that perspective, you see here that that happens literally about 20 minutes later. We're getting that pop up. If we've gone from, you see, we're about 607-ish. We pop up to about 608 and a half. You've moved a point and a half in the Qs. That's what, like two-tenths of a percent in the Qs. And you're up 50% in your options, right? So you get your leverage is like what 250 to 1 theoretically or something like that as it works out. Because there is time loss. Of course, that's part of it too, right? But the reality is, of course, we're getting that big volume surge continuation. And so even the beauty of this is that guess what? If you had not taken the 50% gain and you have to endure this retracement right back into the green VWAP line here, guess what? Right about the VWAP support line here, you're back closer to break even or barely up, right? And you're kind of kicking yourself going, man, I was up 50% or more, and now I'm back to break even. What do I do now, right? We want to take away those what if questions, those what should I do? The always the questioning that a lot of people can do to themselves in any trade and say, look, guess what? Once you've got your risk money off the table, 14 of the 20 were sold at 50% gain you will let the other six contracts ride until at least 330 or so, or until you get to 500%. If it goes to down, even if it goes to nothing, it can happen that way, right? If it goes to nothing, you're going to break even on your whole trade. That can happen. It will occasionally happen. But usually there'll be some value to salvage come 330. In this case, you can see a 609 call. We've gotten up to 611 by the end of the day, up almost about $2. We're out at a buck 95, up 306% relative to our just under half buck entry to almost $2, right? Almost you see right at a four bagger for the last piece. And the key was that you didn't get flushed, you didn't get faked out, you didn't get into the questioning game that too many traders do, right? So that's really what we're after here, helping you to manage that risk and saying, look, that trade generates over 1,200 bucks. Of course, even if you paid a buck a piece on the way in and out, that would be a little pricey by today's standards. A lot of people that are more active probably paying a half buck or 60 cents a contract, but you get the idea that, hey, even a buck a piece, you'd still be up like 1,180 bucks, give or take, right? So you get the idea that, this is where you can make a lot of dough very quickly, but the key is that you've got to think in risk management terms first, right? So if you think about how to manage your risk, which is saying, how do I get my initial risk capital back quickly, selling two-thirds or a little bit over that 70% here of my position up 50% and saying, okay, now I can't lose on the rest of the trade, even if it goes to nothing, right? Even if it totally reverses and goes the wrong direction. But the runner is where you get the bulk of your profit, right? Here again, six contracts out at 195 bucks a piece. That's making you right about a buck and a half times six. That's making about 900 of your 1,200, about three-quarters of your overall gain for the last 30% of your position, right? It's almost like the 80-20 rule, right? It's like 75-25. You get the idea that we're basically getting the bulk of our profit from letting the minority of the trade run. When it really wants to go, it'll go a lot. Now, not every trade is going to hit that final 500% target. Most of those will not, right? But the reality is that when they do not get there, then we're out at 3:30 p.m. Eastern. Now, remember, the Qs may stop trading at 4 in the traditional market hours, Wall Street time, but the QQQ options will trade until 4:15. Okay, so people forget that, but the reality is, yes, that's one of the other nice things to know is that it will keep trading a little bit after 4 o'clock. Now till 4:15. Now here's another one. You can see the upside breakout. We can see we waited because we didn't get the volume confirmation on that first breakout side of that opening range high. So we waited a little bit. You see, we liked that it also had broken above our moving average. Here's another case where as we get in here, thanks to that volume confirmation right about 10 o'clock there, you see we do have about 15 minutes where it's edging slightly against us. Actually comes right back into both the black moving average and the green VWAP line. It's very almost touched as well, right? So you say, why don't you wait for those? Well, because you may not get them, right? It may be a rocket ship that keeps going. You don't want to get left off of the takeoff point, but you got to know that there's a point at which you will pull the plug. For us, it's just a 50% give back. Here we bought 8 contracts at 115 bucks a piece of the 623 calls. When we're trading in the neighborhood about 621 and a half, we're like a buck and a half or about 0.2% out of the money. Right. So you know where the biggest leverage comes as an options buyer is we go from somewhat out of the money to in the money, right? And so that's really where you're taking advantage of what's called the gamma boost, where you get more and more bang for your buck on each successive point move in your favor, right? So we're not trying to scalp the whole position for just a partial point or part of a point on the cues, right? We're trying to get multi points, right? So we go from about 621 and a half up to about 623 and a half. First couple points move in the cues. Again, not a huge move to get us to the 50% profit. And then you see when 330 hits, right about, we're basically getting out of the last piece only up 95% of the last 2 contracts. So that's not going to be as big of a win, up 568 bucks before commission, 550 or more net. But the idea is that we're just saying, look, clean it up, moving on. You can see it did roll over as we came down. We were out about 625 and a third, and then it comes down to about another point. You wait on that, and you're going to give back most of your profit if you wait till the end of the day, right? So it's one of those things where it's just about when it's time to clean them up. Think about it. If there are a lot of people who are starting to do zero DTE options trading, they got to have a way out. And so guess what? A lot of the volatility you can see in the final half hour or less, right into the close and even slightly after because of the way that the Qs trade till 4:15. What does a losing trade look like? I mean, they're going to happen, right? Here's one where we just unfortunately just got faked out on the way down before then it snapped back later, right? But it happens, right? So this is the case we're getting lots of volume on the breakout, feeling pretty good. It's not huge clearance of that first high, but it is a clearance point there. So we're getting in right after that. And you can see that we're, as it turns out, getting stung by the next 15 or 20 minutes. It dips on us first, right? We're in about 604 and a quarter to 604 and a half. We're buying a 610 call, so we're like 5-ish points out of the money. We're paying 66 cents, 66 bucks a contract. And you see it snaps down to from almost 5 points there, right? Almost a full percent in 15 or 20 minutes. That was rough. And that knocked us out down 51.5%, right? So it's going to happen. And so you have to be prepared for it. Of course, yes, by the end of the day, it comes back. But again, it's not about a woulda, coulda, shoulda. It's about saying, okay, just know that you're going to have to live with some of those where you get faked out. Some of those you don't get faked out and would have gone down 100%, right? If you don't take the 50%. So the idea is that there's a constant trade-off happening, risk and reward. And the good trades that you will see from us, it will typically not have that much retracement. But we'll get some occasional pullbacks into some of those support lines, right? So we don't want to wait around on those. Just know losses are part of the game. And so your job is to manage that risk always, right? So that's a big part of it. So from this perspective, we see that here we go, that basically we're not having any overnight risk. When you come in the next morning, you don't worry about if Broadcom had good or bad news. You don't worry about the next earnings report. You don't worry about what comes out of Washington, D.C. overnight. You don't worry about what happened in Iran, what happened with oil prices, what happened with the Fed or anything else from one day's close into the next morning's open. You sleep. I sleep really soundly. Some people say I love to have some action to root for or whatever. That's not how I have operated in 37 years. It's basically saying if I've got overnight risk, I'm going, okay, what do I do to manage it, mitigate it, reduce it, and not have to sweat it, right? So sleeping soundly is a priority for me and for our subscribers. So the bottom line here is that, of course, you don't have the expensive option contracts either. So it's really ideal for smaller accounts to kind of cut your teeth. But when you do get started, do start small and build up. Because I always tell new subscribers, your first goal should not be how much money am I going to make. That's not the first thought. I know it's the tendency. We all think, how much money am I going to make on my very first trade? I don't want you to think that. What I want you to think is, how can I prove to myself that I can execute this system through thick or thin, through ups and downs, through big wins, through stop outs, and not get too high or too low, right? Because of course, leverage is a double-edged sword. It's just a reality of what we deal with as traders. So you've got to manage that risk always. Okay. So here's another one where you see that we did get that first contract target out pretty quickly here, right? So again, we want that text, we want to be able to get in quickly after that first big surge and say, okay, guess what? And at 67 cents, 67 bucks a piece. In a matter of about 15 minutes, we've gotten to a buck 01, right? So we've gotten up into our 50% target, right? So this is why, again, pay attention to your text, right? Know that, your text should be on loud, whatever gets your attention, buzzing and loud, that basically you get it, you say, get logged in, get into this trade, get your, whatever your designed risk tolerance is, get your position on. And then this is a key that we got it, the target, and then guess what? We would have been stopped out, I'm sure, by the time it came all the way back into the moving average and back slightly under that opening range. If we hadn't gotten that 50% gain, I bet we would have gotten the 50% loss right there. Okay. And so bottom line is that guess what? When you say, well, gee, how could you hold it through being up 50 and now down 50? Once you're up 50, two-thirds are gone. You've got four contracts left. Those four contracts are left to run until 3:30. Okay. It's just a matter of giving it a chance. As you can see, come 3:30, we're out at like a buck 55, 155 bucks a piece. Rather than having gotten stopped out for just a fraction of a dollar, 33 cents or something like that would be the stop, right? We didn't get whipsawed by that. We made some extra change because of it. It's not a massive home run, 692 bucks on a massive a maximum of 1,000 bucks. You still see it's still a healthy return for a day's work, right? That's what we're after here, is that type of a bang for our buck. Now, or sometimes we'll get that first target and the remainder will even be closed at a loss, right? So what does that look like? It's going to happen, right? So here's a case where we kind of round tripped, right? You can see that we got that first entry and then that first follow through target about 20 minutes later, right? 62 cents went to 93 cents and we said sell your two-thirds, so 11 of your 16 contracts on the $1,000 cap. And so you're getting that risk money back and a little bit more. And guess what? By the time it round tripped late in the day, we're getting to our 3:30 window. And guess what? There's nothing, maybe a penny or something. We just said, just it's not even worth closing at that point. Just take the last five and let them go. Bye bye, worthless, expiring worthless, of course, under 610. You see, it did snap back, but of course, not getting back over 610 in the final 15 or 30 minutes there. But the idea is that, okay, guess what? You still made $31. I mean, basically, with Maestro commission, it's a scratch, right? Give or take. But you get the idea that that's going to happen, but that it still is worth giving it a chance to run. If you put the preemptive stop underneath the moving average, underneath the VWAP, you will see that you leave some of those little fake outs of the rest of the traders out there that we actually are able to say we don't get faked out on that last piece. Sure, sometimes it doesn't go, but the idea is that when it does keep going, the big trend is where you really get paid and you give it a chance to just keep running. And basically that momentum up or down can oftentimes keep building and building on itself for the day, right? So you see, what about put trades? We showed you that first one, but you can see here's another big one here that was hit back in March. March, of course, was mostly a down market for the NASDAQ and the markets because of oil prices surging, right? And that didn't preemptively say why we should be trading puts. It still said, look, just follow the system. The system says, okay, look, we're catching that breakdown March 20th. You can see as we caught it, we're maybe a point or so out of the money buying the 586 puts when we're about 587. And you can see that we bought them for 122 bucks a piece. Gets us 8 contracts in for just about what, 984 bucks. And you can see that sell 6 of those when it goes up 50%. I think this is kind of remarkable, but you say, well, it doesn't look like it moved that much more between the time we got out 50% to the time it made that low. But guess what? Within 5 minutes before that low, we had our 500% gain. You say, what? How did you go from 50 to 500%? It doesn't look like that much, right? But we're going from about 584 down below 580, right? And so the key is that that's where you're picking up that extra bang for your buck. You're literally going from slightly in the money by a couple bucks to now you can see at the lows, we had a 586 put at the lows where you can see pushing to about what over $7.50. So the idea here is that look, we're taking that down. There's still some time premium in that as well. So that's why we're out slightly before that low, 732, 500%. We don't know if it's going to keep going down or snap back. Obviously, when things get stretched, they can snap back the other direction quickly, right? You see all the volume coming in. You say at the end, is that something that's a really bullish sign? Well, not necessarily. You see a lot of volume spiking right near the end of the day based on institutions either putting on or taking off QQQ exposure, right? Because the reality is a lot of them will use the Qs not just to get on more bullish exposure, but of course to hedge, to they could sell the Qs short, to not sell a bunch of their stock holdings, but just to create a hedge against it by selling Qs, right? So you get a lot of different things happening into the close. And that's where a lot of institutions will make a lot of their decisions. Whereas often the first hour is often called amateur hour, where a lot of newer traders will get stopped out right off of a little fake out, kind of like what we saw this morning. Anyway, point being that look, you can see those last two contracts made us $610 a piece. So the last in profit, just the last two contracts made us over $1,200 of our just under $1,600 of the total. So again, about three-quarters of our profit comes from the final quarter of our position, right? So that's the point of runners. Give it a chance to run. That's where you can really get paid. Another one, you can see this one was back in February. You see we're getting that first little opening range setup, right? You see there's our high-low range defined in that kind of shaded green area there, right? And you see we immediately broke it right after that third 5-minute bar low was in place. The very next bar we closed down. We see we're getting our alert out. It actually bounces against us in the first 5 minutes. That's okay. I actually like to see that and make sure subscribers are able to get in, right? I want you to be able to get in and take advantage. What we think has lots and lots of potential to come. So here we go. And now 5 of our 7 are sold there. So again, with an odd number like 7, you say, okay, well, 5 of those 7 exit, right? We couldn't exit 4 of the 7. That wouldn't get us all of our risk money back at a couple $100 a piece. But 5 contracts at a couple $100 a piece gets us our $1,005 back. We got into the trade for like 938. Anyway, point being that look, you see only got 2 contracts left. Guess what? The last 2 contracts get to the 500% target literally about maybe 35 minutes later than our first target. That's pretty remarkable, right? How fast these things can move. That's the Qs going from about 609 to about 602 in under an hour, right? That's a 1% move in the Qs amounted to 450 extra percentage points in our last 2 contracts, right? That's pretty remarkable, right? But it shows you why we say, okay, at that point, take it. As you can see, the rest of the day, it chopped around until about 245, and then had one more leg down from 604 to 600. But again, we're not going to try to be heroes and predict can it keep going or not. We're just going to say, look, bulls and bears can get rich, hogs get slaughtered. Let's not be piggish. Let's go ahead and lock down that 2 contracts, $800 a piece. Each of those made us $670 a piece times 2. That's you can see like a $1,340 profit on the last 2 contracts out of our total $1,675 profit. You see how the majority of our profit is coming from the minority of our final runner position. Another one on the downside, you can see this was a real cheapie. You can see we bought the 616 puts, paid 34 cents a piece, right? So we're getting a lot more contracts, 29 contracts, sell 20 of those 29, up 50% about a half hour later. And you can see that now it bounces against this once, then it just keeps trending. And our 500% is reached here at just a couple bucks exit on the last 9 contracts, right? So again, you see bulk of the profit coming from the final 30% or so of our position, making $1,870 overall on initial just under $1,000 invested. So you get the idea how to rinse and repeat these again and again. How about another time stop? Still worked out nicely here. This was a buy back here mid-April, April 13th. You can see first initial action looked like it was working its way lower, right? You don't want to be too reactive off of the open. You want to say, okay, let's set that opening range high and low, and now let's see what we can do. And so you can see here that we get a situation here in which we get the 50% gain about midday, right? So it took a little bit of time, right? We're bumping, we're guess what? When we get this first rally and then it comes back into both our VWAP and our moving average, right into that area, we're going to be down a little bit, right? Because we bought it on the breakout and then it kind of retraced. Didn't retrace badly. That's a very normal pattern. You can see again, it breaks out and then it retraces. We haven't gotten the 50% gain yet. We're not making much money yet. You don't want to lose patience with those because the trend is your friend. It's still working in our favor here. And so you see here that what we have is that when we've got a situation in which we do after that second bounce off the moving average and almost VWAP line there that we do get that first target at 171 bucks a piece. That 612 call when we were about 611, 610 and change to start, and we're now up to about 613 and a quarter. You see we're up about a buck and a quarter above the strike and we're a buck 71. There's not that much time value in these things anymore, right? The time is burning the time value away from these, but that's why basically it becomes an even more purely leveraged play as it goes more in the money that basically you're controlling uh so much of the Nasdaq for so little that bang for your buck is dramatic on that last runner piece here. In this case, it's only a 224% gain in the last two contracts, and it still works out to 850 bucks or so in profit for an 8 lot in and out. Gross 854, net in the neighborhood of what, 840 or so. But the idea is that, okay, and yeah, it popped a little bit at the end of the day. I don't care what happens after we get out, right? It's about giving our subscribers time to get in, time to get out, not ever sweating you're taking it too close to the 415 expiration. So how do you start taking advantage of these? Well, I've just set up a super special for the Mad Hedge event today where I like to give a lot of value. I like to give so much value that basically one trade can easily pay for a lot of subscription time and a lot of access to a lot more trades to come. So what I've done is I've set aside 25 spots at a super value for the next entire year, a 12-month subscription for the next 365 days for less than a buck a day. Okay, that's what I'm going to give you today. 12 months of trailers. If you were buying this off of our website at bigtrends.com, typically you pay 297 bucks to try a month out, right? You're going to get a full year for that. We're going to take a $3,500 value for the year, 297 times 12 months, and we're going to basically say you're getting the equivalent of a typical 1 month investment. We're going to magnify that times 12. We're going to give you 12 times the value here. We're going to give you 12 months for just not 12.97, not cutting it down by about two-thirds, but actually cutting it down by more than 90% off when you use a special promo code. I'll show you how to do that in a moment. The code to save you a grand is day 1000. Takes an extra 1,000 bucks off for this same day zero DTE strategy. So bigtrends.com/same day. That's your special link that we've set up for you here. Let me show you how to do that. Remember that code day 1000. If you can't remember it, we actually even do you a favor and list it out on this order page here. So I appreciate the heart going up there. Thank you. And bottom line is that, look, when you go to that page, this is what it looks like. You say, okay, 12.97, that's like 100 bucks a month. That alone would be a great value for the fact that we expect to get you in the neighborhood of potentially about 8 trades per month, maybe about 100 trades a year. Well, if you were paying 12 bucks a trade or whatever, you'd go, that's still a great value for a trade that can make me 1,000 bucks, or I'm going to show you 1,500 to 2,000 bucks really on a number of trade examples that flew to their 500% eventual target on even the minority of the position. But if you forget that promo code, we've actually reminded you what it is. It's day 1000. So what I do is I just copy it there. You can literally just block that and copy it. Go down here to the have a promo code link there. When you click that link, it'll pop up this promo code box and you can just paste it in, or you can type it in day 1000, day 1000, day 1000 saves you 1,000 bucks. Hit apply though. You can't just type it in. You got to hit the apply button to the right. And there you go. Instant $1,000 coupon saves you an extra 1,000 bucks for 12 months of zero DTE trades, right? For the next 365 days, just 297 bucks. There's no auto bill, future bill. Try it for the next year. I think you'll like it. I think you're gonna not like it. I think you'll love it. But I'm biased. Of course, I want you to get comfortable. And I want you to know you've got enough subscription time that you're not basically in that mode of saying, oh gosh, I've got to do something really fast. I've got to, make a bunch on this next trade they call out. No, I don't want you thinking like that. I want you thinking like, I've got to prove to myself that I can follow this thing slow and steadily through winning trades, through stop outs, through trades that, go on big, the trades that don't go big, and basically saying, look, it's all about execution. If If you execute slow and steady, you're going to really believe a lot more in your ability to fire when the next entry signal comes, when the next stop out comes. You know exactly what to do. You're never left hanging. A couple ways you can get signed up there. Of course, take all the major credit cards in this payment box below there. You see the credit card logos there. But if you do that, you type in all your billing information. And if you do that, make sure you get your email in correctly because that's the first place we're going to send you follow-up instructions on all your extra bonus information, including your member site access, the settings and rules so you learn the system, even though you don't have to do any of the work. We call it every trade for you. But I like my subscribers to know about it. You can see and understand it. So basically, you learn it over time. Terms and conditions are spelled out in that link there. Check it out, how we've done business now in our 27th year here at BigTrends.com. Click the I agree button, hit the green, complete your purchase if you're putting it all there. If you want to save a lot of typing, so review terms and conditions, click off on I agree, and then click over to PayPal with no typing on that page other than clicking through securely to PayPal. Log into your PayPal, choose your money source a few clicks later. With the promo code applied of day 1000, you've locked in the entire next 365 days for under $300, just $297 today with that extra instant $1,000 savings. Remember, this is something where one trade can make you multiples of that ROI, right? $1,000 invested. We showed you a bunch of them can make 1,500, 1,800. You know, we don't want to promise what any one trade can do because guess what? Any one trade can win or lose. And you will have winners, you will have losers. So a big part of your objective here is you must be smart about your capital allocation. You should not be getting greedy. You should not getting into a hope mode on a trade that's not working. If it hits your stop, you're gone. If it hits your first target, you've gotten to a risk reposition. Now you let the rest run until 3:30 until we get to the 500% target. Either way, we're cleaning them up by 3:30 Eastern. For QQQ options stop trading at 4:15 Eastern. So you still got plenty of time to get on out, win, lose, or draw, right? So the key is, of course, from frequently asked questions real quick before I hand it back to John in a few minutes. Let me just kind of remind you that. Oh, and by the way, I did a complete strategy session to go even deeper into the system, into the rules. So you learn the specific parameters and rules as an insider once you become a subscriber. So you get that strategy session with a high definition quality. Watch as many times as you want. And my team's always standing by to answer questions. Fellow traders that basically can answer any question you've got. Some of the FAQs, frequently asked questions we get about zero DTE options trader. What's our strategy again? It's keeping it simple, the KISS principle. We buy a call when we're bullish, we buy a put when we're bearish. It's slightly out of the money, okay? Typically. So bottom line is that we're looking for bang for our buck as it goes from out of the money to in the money, right? And we've got the 50% stop in place. We got the 2/3 or slightly more of our position out at 50% gain first target, and then the 500% target on the rest. Real-time emails and, of course, the text alerts sent out through WhatsApp right now. Bottom line is that we want you on that text list as well, never missing an entry or an exit instruction if we have to adjust anything on the way out. Bottom line is that we'll tell you what to do. We'll never leave you hanging, and my team's always standing by at our 800 Big Trends line. New trades out only between 9:50 a.m. Eastern to as late as 10:05 a.m. Eastern, right? So a 15-minute window once we've gotten our first 15 minutes or so high-low opening range setup in place. Okay. Same day exit by 3:30 at the latest with the 500%. If the 500% profit is not achieved, if we're out earlier at the 500%, we're done for the day. It's a good day's work, right? Getting the 50 and 500% targets when we get them, we lock them down and say, book them, Dano. We say up to 10 new trades a month. I'd say probably expect more like 6 to 8, but hey, every once in a while you might get up to 10. But, you know, we expect still in the course of a year to get up to maybe about 90 to 100 trades in a year for under $300. So getting massive value here. Average entry price of a contract around or just under 85 cents, $85 per 100 shares for one option contract. When the Q's right now trading at 743 would cost you 74 grand plus, right? So you're getting tons of leverage, tons of opportunity here, and you get a lot of education. Weekly video training from me, the settings and rules with that strategy session. And then you also get access to my email, to email my analyst team and myself if you've ever got a question on a trade that you're not clear about. Why do we make that trade, or what's not understanding the system, not understand what we're doing? We'll confirm it with you. Here's another reminder of what one trade could have done for you. This is the trade we just had here back on May the 12th. Remember, market's been going up, but we can still catch the downside too, right? You get these retracement days. Sometimes even in a trend, the reversal days can actually be even more powerful, right? You've seen it. You've heard that in bear markets, some of the best one-day gains of all time in stocks have happened in bear markets, right? I mean, the reality is the same thing in bull markets. Some of the nastiest one day moves can be on the downside, right? Because you go slow and steady up and then bam, hard down, right? So we want to be positioned to trade either side. We're not going to be locked into just the fact that it's a longer term bull trend. We could still have a put trade in a longer term bull trend, right? Because we're catching a short term shift here, right? You see it gap down on a Tuesday morning, started to try to bounce, and then as we got the follow through there on that just around that 10 o'clock window there, we're getting in $88 a piece using the 50% stop. Like I said, it almost got to the stop, but not quite. So it kept us in the game, and then we got onto the target literally about a half hour after we got in, first target, and then final target achieved right near the lows, right? We're not always going to catch the lows like that per se, but that's why we use 500%, why we don't go for more, because we know, okay, look, that still amounts to a healthy $1,600 plus net profit, um, about 1650 net for, the fact that, hey, we were in that trade and out of it by midday, right after 1245, maybe 1250 as an exit point there. So the point is, you invest 297, you get a trade that makes you over 1500 bucks. You got five bagger ROI on your initial investment, and of course the service is yours for the entire next 365 days. Will take you all the way to early June of 2027, right? So we're covering you through the rest of this year and through the first 5 months and change of 2027. So like I said, 12 months would normally be a total of $3,500 plus a value, 297 a month times 12, right? But today, when you go to bigtrends.com/same day and you use that special link that we set up for you here, taking it from the 1297, that cut down in two-thirds there, and you say take an extra 1,000 off. Why am I doing that? Because Mad Hedge has been good to me to be able to show you a unique way to take advantage of this market volatility on a day-by-day basis. And again, remember, if you're worried about day trades, we're not going to do a ton of them on a week-to-week basis. But the reality is that that pattern day trade rule has now been abolished. So you're going to see more and more brokers coming online to say you can trade with even a small amount of money, as many day trades as you want going forward and coming times here. So it's a really great time to be an active trader. And of course, with the incredible moves that we've had in the market, the NASDAQ is my favorite vehicle to do this strategy on. So the QQQs are the most active, most liquid, and of course, fastest moving vehicle. So that's why when you go to that link there at bigtrends.com/same day, you get to take advantage of it. So do it now. Use that promo code day1000. I'm out of time, so I'm going to hand it back to John and say thank you, John, for having me. It's always a pleasure to share what we're doing at Big Trends to take advantage of these market conditions.
Well, thank you very much for joining us today. Very educational, a lot of great trading advice there. I think I'll take up some of it myself.
Thank you, John. Appreciate you.